He's having.
Nancy Dean, Chairman of the West Hartford Pension Board. Welcome to the virtual meeting on June 21st, 2021 of the West Hartford Pension Board. Because in-person attendance at public meetings is likely to increase the risk of transmission of COVID-19, this meeting is being conducted in accordance with Governor Lamont's Executive Order number 7B, which permits municipalities to conduct public meetings virtually. Members of the board, some town staff, and Chris from Fiducient will be participating with us today. Members of the public can view the meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV Channel 6098 at www.whctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town's website. We also have a member of the public attending the meeting this morning, Mr. Perry Salonia. Good morning, Perry. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I ask that all participants please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see your hand go up. If you are participating via audio only or I do not call on you and debate is ending, then please unmute your phone and let me know so that I may recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions will still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time you speak. Fourth, because of the difficulty in tallying voice votes on a video conference, I will ask that Lori Carney assist me in the roll taking. And fifth, a reminder that if any participant has a problem with their connection, please immediately call Lori Carney. I will now ask Lori to take the roll.
Okay. Lori Carney, clerk of the board.
Nancy Dean.
Present.
Lazaro Guzman.
Present.
Al Lebo.
Here.
Ethan Goldman. Ethan,
Is
you
he
must be
not
on
here?
mute. I see him, and I see. Hi, Ethan. Are you there?
There he is.
Brittany is absent, and Peter Privitera.
Present.
Hi, Ethan. Are you there, Ethan? Okay, Mayor Cantor.
Here.
Matt Hart. Chris Kachmar.
Lori, it's Pete. Matt is unable to attend this morning. He's going to try to dial in later on.
Okay, thank you. Chris Kachmar.
Here.
Rick Ledwith.
Here.
Lee Gold. Paula Kanaki is absent. Perry Salonia.
Present.
Morning. And Jennifer Evans set up the recording. Ethan, one more time, can you hear us?
I can finally hear you. Sorry about that.
Okay, great.
I got phone as well as the video.
Okay, thank you. I think we're all set, Nancy.
Okay, good. All right. Well, we thought that this was originally going to be an in-person meeting, and maybe it should have been. This has been a little complex this morning. Good morning with that. We do have two important items on the agenda. We do have a disability application for this morning, as well as we want to concentrate on the final investment approach for the pension bond proceeds. So before we get to that, we do have the minutes of Monday, April 5th. I do make a motion to approve the amended minutes of that virtual special meeting on Monday, April 5th, 2021. Any discussion or any questions? All those in favor, please say aye.
You want me to do the
Oh,
vote?
yes, I forgot.
Okay.
See? Yep. Sorry, I'm in another meeting. Go ahead.
Okay. Peter Privitera,
Yes.
Ethan Goldman,
Did we lose him again?
Ethan. Okay, we'll go back to him. Al Lebo,
Aye.
Lazaro Guzman,
Yes.
and Nancy.
Yes.
One more time, Ethan, do you approve the minutes? No. That's a yes. Okay. I'll accept that.
Okay.
Okay, thank you.
All right. Then we have a motion to approve the minutes of the virtual regular meeting on May 10th, 2021. So I make a motion to approve those minutes. Lori?
Okay. One more time, Peter.
Yes.
Ethan. Oh, Ethan.
I'll try again. It's working this time?
Yeah, I hear you.
Yeah.
Yes, excellent.
Yeah.
Okay. Al,
Aye.
Lazaro Guzman,
Yes.
and Nancy Dean.
Yes.
Okay. Motion carries.
Okay, great. Thank you. Thank you all. Pension administration. I don't know if that's going to be Rick or Lori this morning. You have a matter?
Hi, Nancy. It's Rick.
Hi.
I'll handle this one.
Good.
Good morning, everyone. Just with a bit of a heavy heart that we discussed the pension disability that's before you for approval. You may have read about Sergeant Tyler's story in the Current and WEHA, but Sergeant Tyler is an 11-year decorated veteran of our police department who was diagnosed with brain cancer back in 2015. Sergeant Tyler worked throughout his courageous battle with this terrible disease. Unfortunately, as this disease progressed this past April and May, and Sergeant Tyler was no longer able to work, he opted to take a pension disability. Unfortunately, shortly after filing his paperwork, he did pass away at the age of 33. His wife Brittany and his two young sons, Declan and Braden, will be covered through the contingent annuitant benefit of his pension. And again, I'm sorry to have to report on this, but would happy to answer any questions that the board had prior to approving the disability pension.
It is very sad. Are there any questions from the board for Rick? Being none, I would make a recommendation, or I make a motion to approve the contingency annuity payment for Christopher Tyler. Lori?
Sure. Peter Privitera,
Yes.
Ethan Goldman,
Yes.
Al Lebo,
Yes.
Lazaro Guzman,
Yes.
and Nancy Dean.
Yes.
Thank you.
Thanks, everyone.
All right, thank you, Rick. Peter, update on the where you are in your schedule.
Thank you. Thank you. We're at the end of the road here. Last week, we released our preliminary official statement. We heard from both Moody's and Standard & Poor's. They affirmed our AAA rating with a stable outlook. We completed and distributed a marketing document to all potential investors. So as it stands right now, we're going to sell the bonds on Thursday, and we're going to close in early July. So right now we're watching the market, and it's been, as the mayor can attest to, it's been a long road, and we're finally getting to the point now where we're going to sell the bonds on Thursday. So so it is important that we decide today what short-term investment option we're going to take. So that's my report. Thank you.
Good. Any questions for Pete before we move on to Chris's presentation?
Pete, do we have oh, sorry.
Say your name, Les.
Lazaro Guzman, pension
Very good.
board member. Pete, do we have a final interest rate on what the bonds, what we'll have to pay, or is that we may not know that till they're actually sold?
Pete Privitera, Finance Director. We're not gonna know that until they're actually sold. This is even though it's a negotiated sale, we'll have a good idea Wednesday evening when we have a meeting and discussion with the underwriters. We're using 4 firms on this sale because the issuance amount is so big, but we'll have a pretty good idea Wednesday evening before we actually sell.
Thanks.
Okay. Chris, up to you.
Well, can I ask a question?
Ethan's hand was up, yeah.
Oh, Ethan, I'm sorry, I couldn't see him on my screen. Ethan?
No problem. Ethan Goldman, board member. My question was, as I read through the notes, and I think I have the numbers right, the original intent was to borrow $360 million, now it's $325. In the base case, or as I view what was the case that we were sent a couple meetings ago at the beginning, there was a plan to pay back approximately $20 million plus every year. Is that plan still there, and the maturity will be shorter, or is there what's the plan with the lower amount, or did I misread it?
Pete Privitera, Finance Director. No, you didn't misread it. We originally received authorization for $365 million of bonds. Now we're going to be selling $324.4 million. Originally, we were looking at a debt service payment, Paul, where it's going to be level principal and interest payment for 25 years of about $20.1 million, I believe. Now, our expectation is that's going to drop about $2.8 million per year, which is great news for us, because it's just going to put us in a better position to deal with this, as well as hopefully provide some fiscal relief to the town as well. we're not going to reduce the term. It's still going to be a 25-year repayment period, but our expectation is, and I'm just speaking from our last conversation, our expectation is that the interest rate is going to be in the roughly 2.65% range on a taxable bond. So we're hoping that that we do very well this week when we actually sell the bonds. Thank you.
So, okay, I apologize. You said that it was going to go from 20.1 to what was the amount you expect to annualize?
Our expectation is the last numbers we ran were, I think it was about 17.8 million, somewhere in that neighborhood, 17.9 million. But again, it all depends on what the final true interest cost is.
So I guess my question, whether to you or to Nancy, is that something we can discuss with the 20.1 versus the 17, or is that town council? Just because to me, it'd be great to get rid of this thing sooner than later.
Again, Pete Privitera, Finance Director. That's a town council decision. The pension board is limited to investment of the proceeds. Repayment of the debt falls under the purview of the town council.
Okay, thank you.
Good. Thank you. Now, for some reason on my screen, I still can't see everybody. So before we move to Chris, I want to make sure I see Mayor.
Yeah, so I thought I would respond to Ethan's comments. So as much as we would want to accelerate, obviously, and shorten the period of this level of pension obligation, the impact on the budget is significant. And so when the models were run, the 25-year was consistent with what we weren't extending the pension obligation period, which is something the rating agencies were looking at, but also, this was the minimal, the best balance of impact annually to the town's budget. So we are going to be running new numbers when we present it to the rating agencies. We are going to be running and modeling our models through to demonstrate what the expectations are. And we'll do this actually probably after we sell, so we know exactly what the interest rate is and what would have happened if we didn't do these pension obligation bonds. So we will have a better idea. Obviously, we don't know what the markets are going to do in the future, but this is the stochastic models that we have run, the 10,000 scenarios. And then we could also run them on the 5% on either end as well, just so we can see. But the modeling has only changed. I mean, the numbers have only changed for the better right now. So we are pleased that we are doing what's in the best interest of the town for the next 25 years. Thank you.
This is Nancy. Thank you, Shari. Anyone else have any questions? Alan, I can't see you on my screen this morning. Any questions from you before we go forward?
No questions, thank you.
Thank you. Okay. All right. Then Chris, we will turn it over to you for the review on the performance of the portfolio.
Right. Thank you, Madam Chairwoman. Lori, I don't remember, were you sharing your screen in this slide deck, or did you want me to?
Laura, you're muted.
You're muted.
Chris, we hadn't discussed it prior to the meeting. If you're able to share your screen, that would be good.
Okay, let's see here. I'm assuming you see here. Thought we had done this in the past, right?
Yes. Yeah.
Yeah. Huh. Bear with me here, folks. I thought we had done this in the past successfully.
Mm-hmm.
Can folks see that or no?
No,
No.
No?
no.
This is not.
Get there.
Yeah, I don't know why I'm I've got it open on my screen and I can see it, but I don't know why it's not here.
Let's see what I can do, Chris.
You've granted permission, right, Lori? I don't know why I've got it up on my screen and I'm staring at our slide deck.
I didn't do anything different with this meeting as with any of the others.
Content.
It looked like we were looking at one of your screens, just not the
Yeah.
presentation.
Yeah.
Sorry, I don't know why that's why I see Lazaro too. I don't know why it's not. I'm staring at the slide deck right now. I don't know why I can't access it. It's open on my screen. Let's see here.
Lori, do we need to reinitiate the meeting or something like that?
I'm not sure. I'm not sure. I was going to try to send it to, see, I'm on a laptop, so I was going to try to send it to, and I'm not connected to our server. So I can try.
Let me see if I can do it
Lori,
this way.
You want me to see if I can access it?
Sure, if you can.
I'm trying to find it, Peter, on my other file here just to see if that'll work, but
Well, we each have the deck, right? I mean, we could follow along ourselves if you can't share it.
Right.
that's that if that works for the group, Alan, that works for me if everyone has ready access to it.
This is Nancy.
Terry,
I think we should all have that. Yes, Shari?
I was just going to say, I don't know if Perry does, but maybe somebody can send it to him if
It-
he
No, I
does.
think he does.
It was
Or
sent
Perry,
to
you
everybody.
should. We sent it to you,
Thank
right?
you. Thank
Perry?
you.
Yes, I have it. Thank you.
Okay, good.
Does if everyone has ready access to it, I'm staring at the opening page and happy to go in that format here and obviously give regular verbal clues here as to where we are in the slide deck if that works for folks.
I think that's, oh, I see something now.
Can you guys see this? I was trying to share it.
I
Yes.
can see it. Yes.
Okay. All right. Well, Chris, you tell me when to advance it then.
All right.
Yeah.
Right, I apologize, folks. I don't know if my system's acting up or what. But so really, again, good morning, and obviously two primary objectives today. One is Peter's referenced. We've got a pool of monies that's coming in, and we need to do two things with it. One, of course, we need to settle on the structure of the dollar cost average, the proceeds pool itself. Over the course of what we've set up initially anyways is an 18-month investment window, dollar cost averaging framework. And then in addition, of course, we'll have a sixth of those monies, again, as Peter mentioned in early July, that need to be deployed into the legacy pension plan. So we need to have a discussion around that as well. So those are the two big objectives today that we'll spend the bulk of our time on. Just from a context perspective, Peter, quickly, if we jump to page on my slide deck, it should be page 4, and we'll be quick here, but we did want to provide a little color and perspective to the board just on what's going on in markets more recently, and we've got some May numbers on the performance front too, just to catch up on that as a link into this discussion on forthcoming proceeds. So month of May here, you'll see working left to right, fixed income equities and real assets. Generally a constructive month of May in the markets. In the fixed income arena, rates were down a bit, base rates were down a touch. Investment grade spreads in a little bit, high yield spreads out a little bit, but generally you see there a slightly positive month for fixed income securities. And equities continued across the globe to do fairly well, positive anyway. So you see there the gray hash bars in the middle of the page, the bars. Decent earnings, a very strong earnings season, in fact, and obviously tailwinds from stimulus continue to be helpful, as well as enthusiasm, if you will, around economic reopening, and you see positive returns across the global equity markets in the month of May. And interestingly enough, better returns actually from the international markets versus the U.S. markets in the month of May anyways. And then real assets generally continue to do well also. Obviously, there's been lots of discussion around inflation and it perhaps being elevated here, at least on a transitory basis. And that is, as you can imagine, right, generally a tailwind for real assets when we're in an inflationary environment. So a decent month of May, all things considered. I think in the interest of time and what our primary motivations are, Peter, I'm going to jump all the way ahead in the slide deck to page, slide number 8 or 9, excuse me, should show the portfolio as it currently exists in May 31st. So we've got the $265.7 million invested asset base in the trust. You'll remember not too long ago, you had authorized a rebalancing effort, and we had trimmed some equities and going back to fixed income just to stay aligned with the 70-30 target I know that you're all familiar with in terms of our standing allocation strategy. And with the managers generally in good working order. You'll remember from our March report, our formal first quarter report, we didn't have any issues across the manager roster in terms of highlighted statuses for any of the managers. They were all on maintain, and I think generally positioned and performing consistent with our expectation. What does that mean more explicitly in terms of performance? If we skip, Peter, to the next slide, slide number 10, top of the page there, just a couple of reference numbers for the board. So a positive month of May, a little bit behind the benchmark, but not dramatically so. And you see kind of that same kind of relative comparative, if you will, quarter to date. Calendar year to date, we've got the plan up about 8% and a touch ahead of the benchmark. And then obviously the more robust numbers for the fiscal year to date, up over 28% from the beginning of the fiscal year. And certainly 1 year numbers and longer dated numbers that are generally competitive with ahead of or in line with benchmark. So I think generally the story from a performance standpoint, by and large continues to be a an accretive one and one that we don't have immediate issues with. And the sourcing of that performance, we won't go through in the interest of time each and every manager, but you'll see on starting Peter, slide 11, I know familiar to most of you, just the decomposed performance across the portfolio. And bears mentioning, I think, just from to keep the disciplines, if you will, we're much more concerned about the longer dated numbers than what may happen in a month or a quarter. A couple of the managers, Silvercrest jumps out near term on a relative basis where they've been a bit behind benchmark. They tend to be a kind of a pretty distinct quality bias manager, and in some of this reopening enthusiasm in their fishing pond anyways, the names that have done the best have been kind of the lower quality names from a financial metric perspective. So areas that they generally don't deploy capital in, but kind of running at least competitive with their peers since they were brought into the program back in 2016, and no particular concerns there from our standpoint. The dynamic for most of the other managers longer term certainly remains a pretty constructive one when you go through page 11 and then on into page 12. So again, I don't want to spend a ton of time here, and I think I'll pause and see if there are questions on general markets, the allocation or performance manager or composite level before we segue over to obviously the stars of the show this morning, which are the proceeds and how to administer to those. I'll defer to the chair.
This is Nancy speaking. I'm just looking at the screen, but if anyone has anything, any other questions for Chris, please speak up. Hearing none. I think perhaps, Chris, we don't have anything of an action in this component. So if you want to move forward to the proceeds discussion. That'd be good.
Absolutely. Yeah, great. Thank you. So I'm going to, Peter, skip ahead to page 14. And there's lots of data on these pages, but I think we've tried to set it up in a logical manner, and we'll try to backfill along the way here with reminders and perspective as best we can. On page 14, we've just recatalogued and updated some of the basic metrics around the candidate firms I think that we've honed in on, and you'll remember they kind of fall into two categories. A shorter term, kind of front end of the curve, fixed income strategies, and then a handful of, at the direction of the board, again, a handful of strategies, again, fixed income and high quality and liquid, but that are a little bit further out the yield curve, if you will, and offer up the prospect anyways in a vacuum of higher yield. The trade-off, as we've talked about many, many times, right, is the notion of the comfort level that the board may have extending duration for more yield kind of versus the core objective of that DCA pool, right? Which you'll remember we've kind of modeled and advertised as being confined to liquid, high grade, duration, short duration, intermediate maybe type strategies. And the far right column here, you'll see what we've done is kind of offered up with the most current metrics that we've got access to. The yield available from these different strategies and versus the amount of duration or interest rate sensitivity associated with those strategies to generate that yield, right? And in all things equal, right, in a vacuum, if you will, the higher that yield per unit of duration, in theory, right, the better compensation you're receiving. So you see that cataloged on the far right. And again, we'll kind of work through some live examples here momentarily, but and we can come back to this page as necessary. But I think it'll begin again to make sense as we work through some of the detail here and begin to bring these strategies together in different combinations for your consideration. We actually have built 4 pools, if you will, dollar cost average pools for your consideration this morning. And obviously we'll take your direction beyond that if need be. So if we scroll ahead, Peter, to the next page, 15, just a little bit more in the way of some metrics around the strategies. You've asked us to confine them, the manager candidates, right, to predominantly investment grade bonds, and you see that there. The managers generally working across the investment grade spectrum and building out their portfolios. Clearly, in the environment we're in, given how low base rates are and given where spreads are, right? Each of them, most of the managers are meaningfully reaching into that, call it the single A and triple B area of the markets, the lower investment grade spectrum, a portion of the spectrum in search of some of that yield. And then moreover, you see again on the bottom half of this same page for the candidate managers, just in terms of sector representation. And the predominant sector, right, for most of these managers is the corporate space, right? Again, where there's that incremental yield available, and a couple of the managers reach a little bit into the amortizing asset classes, asset-backed and mortgage-backed securities as well, trying to source some of that yield. So again, I'll pause and we'll kind of work our way through this, but just want to kind of get you to kind of cut to the chase here momentarily, and then we can kind of gather our thoughts and begin to think about what may appeal to the group. If we jump ahead, Peter, to slide 16, we've highlighted here for you just the short-term managers and performance characteristics through May, just for the group to be mindful of what's going on recently across the different fund candidates. So you see on the top of the page here, each of the managers and their numbers year to date, which are fairly nominal, right? As we all know, given where interest rates are and where they've been. And then you see the 1, 3, 5 year and longer dated where they're available. Modest returns, but consistently positive returns. And as you can see there, generally the candidate managers doing reasonably well versus the benchmark too. We're using, kind of triangulating, if you will, around a short-term government credit index. You can use the 90-day Treasury bill as a proxy as well, just in terms of where the managers are. And you see some fairly consistent performance. And then just in the interests of kind of just being fully aware as we begin to think about the different potential permutations of these managers, you see that we have expanded on a calendar year basis performance, and just kind of highlight, I guess, the 2008 timeframe, right? If you think back, it's been a while ago, but that was really kind of very much an acute financial crisis, as you all remember. And there can be periods for certain of these managers. These are calendar year numbers, right, where you can have a negative return. It doesn't happen very often, and you can see there, in fact, for this cohort of managers, it hasn't happened really since then. But you do get in a period of stress to an extreme, right? We can't guarantee that we wouldn't have a non-positive return. So just something to be mindful of as, again, we think through the combinations of managers momentarily. We do the same thing if we jump, Peter, to page 17. You'll see there the intermediate managers, right? So you'd asked us to look at some folks who worked their way out the yield curve a little bit. And an interesting dynamic comes out here, right? We've had interest rates, as you all know, move a bit higher, certainly at the front end of this calendar year. And you've seen, right, year to date, actually for the intermediate managers, negative returns for all three. Nominal negative returns, but negative returns nonetheless. Again, the story here longer term is, I think, a constructive one that leans in favor of the managers versus benchmarks. You can see here we're just using the Gov Credit Intermediate Index as a proxy. And the managers generally have been, up to par, if you will, outpacing that benchmark. That same set of calendar year metrics are provided at the bottom of the same page. And again, I would highlight 2008 just to give you a flavor for a really tough time. Western didn't have a strategy in place just then yet, but you see the Vanguard strategy was down 6%, Baird down a little bit less so. 2013, kind of another mediocre year for fixed income there, and you do see, some negative return. So the takeaway from all this data, right, is for the vast majority of times when things are kind of running, quote unquote normal, the managers are pretty consistently generating a positive absolute returns, and moreover returns that outpace their representative benchmarks. But we can't say that in an absolute there are periods and infrequently where we just need to be mindful that there can be negative returns, and more so when you reach out the yield curve a little bit. If we jump ahead, Peter, just to play on that point of performance for the board before we start to look at portfolios in just a minute's time, on page 18, we cataloged for you. I think you've all seen this chart in prior versions of the slide deck, but we did want to just show out the drawdown period. And again, you go back to the 2008 timeframe, as you see there, where certain of the managers had negative return, but again, by and large, you see there, using the vertical axis there, you can see the vast majority of time the managers are generating positive return and snap back pretty quickly, even from bouts of more challenged performance. And then the final thing I'd leave you with, just in terms of background and perspective, on slide 19, we touched on this very briefly at the front end, but just this concept again, right, of yields per unit of duration. And you see we've plotted through May. The dark blue line there is yield to maturity for the aggregate bond index. And then you've got the duration, which is extended and as long as it's been in quite some time. And that results in a metric, right, or a compensation for more interest rate risk that's fairly low. You see in the very lower right-hand corner of page 19, that yield per unit of duration at 0.23, about as low as it's been in quite some time. So that's just the backdrop for kind of how these different candidate managers have done, that our research team has kind of brought together, where they're finding opportunities for return, being mindful that there can be periodic bouts of negative return, although not that often. And just this dynamic, again, when we think through what you ultimately want to do with those proceeds in terms of the different candidate strategies, there isn't a lot of compensation right now, as you all, I think, well know, for doing too much in the way of extending duration in terms of yield metric, or yield addition, if you will. So with that, I think what I might do, I'll defer to the chair, of course, but if there's no questions, I think this comes into much better focus when we actually start to look through some live examples. So if no one objects, I might touch on each of these first, and then we'll have, I think, ample opportunity to get more detailed and share your concerns or comments, if that makes sense.
This is Nancy. Yep, I think that's a good approach, Chris.
All right, great, thank you. So if we jump, Peter, to page 20, we start with what we're labeling and calling just a purely short-term focused dollar cost average framework, a pension obligation bond framework, excuse me. So we've confined the strategies, as you see here, to those very short-term liquid managers operating on the front end of the yield curve. And working with our research team, we've kind of mixed and matched them in what we think is a reasonable and thoughtful manner. So you see this version 1, all short-term, using Baird as kind of the lead strategy. And then what we've done is just cataloged for you there. Again, they're renewed their duration, the yield on the strategy currently, fee. So you can see the short-term, exclusive short-term mix would have a duration of about 1.1 years and would be yielding, call it 56 basis points, and have a fee associated with it when you look at the expense ratios for the underlying funds on a weighted basis of about 16 basis points. So this would, in a sense, right, be the I would call it the most conservative option available to the board in terms of what do we do with these proceeds when they arrive at the town in early July. This on one far end of the spectrum would be the most conservative mix. So again, we'll come back to these numbers and bring them all together for you. But 56 basis points of yield and a duration of about 1.1 years. If we jump ahead, Peter, what we did on slide 21, again, working with our bond team, our research team, we just weighted the two intermediate managers that we thought would be worthy candidates, and we kind of brought them together in what we thought was a reasonable manner. So the Baird and the Vanguard strategy together mixed, as you see there, a higher yield, right? You know, we're going from 0.56 to a yield of 1.2%, a little bit more expensive. No surprise, right? When the managers are operating out the yield curve, it gets a little bit more expensive. But be mindful, right? So we are doubling the yield, but we're taking on duration that is, right? What is it? At three plus additional years of duration for that yield, right? We're going from 1.1 years to almost 5 years duration to get that a little bit better than double yield. And I think as everyone remembers, right, in a vacuum, that duration metric gives you a little bit of a sense, right? If you remember back to, economics or financial economics classes, an immediate 100 basis point, overnight jump in interest rates, all things equal, would mean the most conservative portfolio would be expected to be down about 1.1%. But the intermediate focus portfolio, right, again, interest rates jump 100 basis points overnight, would be expected to be down about 4.8%. And then what we do is we begin to mix and match the two. Again, I think this is our sense is what the board's interest was maybe trying to strike a common ground somewhere in between. So portfolio 3 on page 22, we've labeled kind of a maturity match, right? So what do we mean by that? You talked about, right, endorsing an 18-month dollar cost averaging window, right? So about a year and a half to get the proceeds fully invested. So we built a version mixing short-term and the intermediate strategy in a manner that kind of gets us pretty close to that duration metric, if you will, right? That 1.5 year number here. So pick up yield from the all short version, right? This is that was 56 basis points. So we do pick up, 13 basis points of yield here. The duration does extend a little bit, but not dramatically so. And then the fees, kind of running back down into those teen numbers using predominantly short-term strategies. And then we just kind of did take the gloves off, right? What if we just kind of fully implicated both short and intermediate strategies in a more, I'll use the term aggressive sense. So on slide 23, we rescale and weigh those same candidate managers. You can see there we're still driving into predominantly the short end of the yield curve for 75% of the total there, but we just add Vanguard in a slightly higher weight given their highest absolute yield. Duration does extend about 0.9 of a year, but we do pick up, 25 some basis points. 21 basis points from the so-called maturity matched version. So those are the kind of the false straw men again. So we had a very conservative mix, an all intermediate mix, and then two that we thought struck reasonable balances between that trade-off of duration and desire for yield. And with that, Madam Chairwoman, maybe I'll pause for a minute. I know there's lots of numbers flying around here, but this group is a pretty quick study, so I'll happy to take all kinds of questions and initial thoughts from the board.
I have a question.
Yeah, I can't see this the screen, but before we do, I just wanted to thank Chris and his team for doing all of the many iterations and discussions that we've gone through on this to bring it to this sort of clean way for us to take a look at what our steps should be here. So who is it that wanted to speak? I don't see the screen in front of me.
I think it was
Questions for Chris?
Lazaro and Pete.
Okay. Peter?
Just had a question, Chris. So the higher the yield, the more aggressive we would have to get in the future with our asset allocation mix to, I'm sorry, the lower the yield, the more aggressive we would have to get in the future with our asset allocation mix to recoup that loss?
All things equal, Peter, remember as part of the analysis, we had done that, we had created that concept of an opportunity cost that you may remember, right? Where we looked at, what do we need to do to kind of recoup some of the potential opportunity cost from dollar cost averaging in. And I think if you remember back to that, it required about 7 basis points more of annualized return for the 23 and a half years, if you will, after the issuance of the bond, which captures the first year and a half when you're in the dollar cost averaging program. So yes, in theory, we'd have to be a little bit more aggressive ultimately in the allocation to recoup that opportunity cost. You may remember back then when we first modeled it, we had confined the model, though, that was working off the most conservative mix, right? So that was working off back on slide 20, if you will, this idea of the very short term, very conservative posture of the dollar cost averaging pool. So these other versions, Peter would mute that a little bit, right? And I think it was Lazaro who had first brought up the idea of maybe having a bit of intermediate to strike that balance, and that brought us kind of full circle to this idea of, again, I'll just pause on the page, page 22, this idea of maybe a maturity match to that 1.5 year window. Being the most logical place that kind of strikes that balance somewhere in between. So yeah, I think one of the other things we'll talk about, right, is that we're going to have to think through the configuration of the legacy pension portfolio and what that looks like. We're going to need to start on the heels of this conversation immediately with what we do with that first slug on the dollar cost averaging front in early July. But I think we've talked about previously as we kind of work our way through the dollar cost averaging program more broadly beyond that in subsequent quarters, we're going to have to revisit with the board just, what that ultimate configuration, reconfigured portfolio looks like from an allocation perspective. Different managers, more managers, new asset classes, those type of things are things we don't have to answer this morning, but I'll have to stay on top of, obviously, and work through over the course of the next several quarters for sure.
Okay, all right, thank you.
Lazaro, did you have a question?
I did. So one of them, thanks for answering it. I think, so in the base case, Chris, it sounded like we used portfolio 1. So in terms of the modeling, so all the others are a slight improvement, but it's not like we're at a deficit compared to our modeling approach. If we started with portfolio 1, it sounds like that's kind of what I heard you say.
That's correct, Lazaro. Yes.
Okay. And then the other question that I had is maybe, as the board thinks about the duration versus yield and sort of the trade-offs, I know I'm asking for a short term, but kind of maybe give us your view on interest rates. They've dropped a little bit. There's a lot of headlines around inflation. Maybe just give us, a quick couple minute kind of overview so that way we can put the duration conversation into context.
Yeah, absolutely, Lazaro. It's always, interest rate prognosticating is always kind of a dangerous thing, as you all know, because it's really difficult to get consistently right. But I think the general view that we've got is, you heard from the Fed last week, right, that they started to begin to get more specific on the very front end of the yield curve, what they might do with rates. And they, they've talked to that happening, I think in 2023 is what they've made mention of, which in theory encapsulates our window on the very front end of the yield curve and rates there staying about where they are. The world is reopening, right? The economy is beginning to grow again in a more synchronized fashion, and they don't control what happens in the intermediate and longer part of the curve, as we all know. And we do expect, probably all things equal, that rates in the belly of the curve and further out probably are creeping higher over the course of the next 18 months. The pace of that, again, I don't think is going to be dramatic, but we do think that they're probably a touch higher 18 months from now than where they are today. As we all know, right, the managers that you do ultimately decide on are investing dynamically versus that yield profile and are kind of rehashing and reconstituting their portfolios in live time. So they're picking up and capturing some of those yield changes and whatnot. So there's some moving parts there. But the short answer, I think, Lazar, to your question is, I think low front end of the curve rates stay where they are through our dollar cost averaging program as envisioned. Intermediate rates maybe a touch higher, but manageable, if that makes sense.
Yes, thank you.
Nancy, other question?
Yes, Nathan.
I think you called me Ethan Goldman. Member.
Yes, Ethan. Yep.
Chris, question for you. I'm assuming the yield is a gross yield, not a net yield after fees?
These are net yields. These are net yields, Ethan.
Okay. So the paid-in would be 0.34% net after fees, right?
Yes, correct.
Oh, okay. All right. I'm good. Thank you.
You good? Okay. Any other questions? Alan, I haven't heard from you.
Thank you, Nancy. Yeah, this is Al Lebo, pension board member. Chris, I'm just curious, in putting together these various portfolios, how you determined which funds to put into here. And in particular, one of the funds that I thought you might have wanted to consider would have been the Bloomberg Barclays Intermediate Government Credit. I don't see it in the mix here at all, so I just wondered how you came up with these various mixes.
Yeah, so that is, as you know, Alan, right? That's just the index itself and its reference. So we didn't model an index sleeve anywheres in the program. I think our decided preference in fixed income, particularly given the uncertainty around rates, tilts us pretty emphatically towards active management, right? So the index that you reference, you could capture that return stream in an index manner. But as you see there, right, if you go back to the performance roles, the active managers pretty consistently outpace that index. So I think when you look at the kind of the legitimacy and sustainability of those track records, we're inclined to use the active managers, knowing you're paying up a little bit in the way of a fee, but that they've been, certainly true to form in earning that fee back and then some. So, that's, I think the simple answer is a preference that we've got for active management and accentuated by the interest rate environment. So I'm Peter, just back on, just as a visual, back on page 22, right, on this kind of mixed version with the duration match, to Alan's point, using a couple of Vanguard strategies, right, that are fairly low cost and bared and paid in a touch more expensive, but we think a 15 basis point weighted average fee is an appropriate kind of balance to strike between active and fee sensitivity. So I don't know if that helps or not.
Okay, thank you.
Nancy, it's Pete. I have one more question for Chris.
Yeah.
Chris, is there any benefit? I'm looking at the slide that in front of us now, portfolio number 3. Is there any benefit in matching up the duration with the period of time, that the 6 quarters that we're going to be gradually investing this money?
Yeah, I don't think, Peter, there's a hard and fast rule, right? But I do think that there's kind of a favorable dynamic, right, or optic that kind of plays out with the boards, saying, listen, we are comfortable with an 18-month window to invest these proceeds, and we kind of want to have the dollar pool that's going to support that effort and program from a maturity standpoint be matched with that horizon, which kind of brought us to this idea of just there being a logical connection between a duration of about a year and a half versus the needs and the pacing of the proceeds themselves. So, your question's a great one. And I confess that I don't think that there's a definitive absolute rule that dictates you do it this way, but I think there is a measure of logic to it. And consistency, right? And awareness, I guess, even moreover, for lack of a better term, of saying, this is the program we're comfortable with. It's going to take us about 18 months, all things equal. And we're gonna take our available proceeds and put them in a mix of strategies that kind of runs or tallies to that type of a horizon, if that makes sense.
Yeah, it does make sense. I'm just thinking, from a perspective of trying to explain it, it certainly simplifies it.
Yeah, right. And just as a reminder to the board, I think we've spoken about this many times, but all of the strategies that we're looking at, right, are very liquid, right? Same day, next day settlement. So these are things that can be reconstituted and reconfigured extremely rapidly. And there's no operational impediments or execution impediments for the board in terms of using them. They're very liquid and very easy to transact in, and very transparent, obviously, as you've seen with some of the data. And they're all registered 40 Act funds, as we call them. So,
Right. And this is Nancy speaking. I think, and Chris, you may want to clarify how I'm going to say this, but I believe we have asked that this portfolio be maintained separately from a performance perspective. So as we start to, as time goes on, you will be able to report how this strategy is working. Is that right?
That's correct. Yes, Peter set up the account with Wells Fargo already, so we're in good working order there in terms of having a home for these monies when they come in early July. And then to your point, yes, we intend to independently monitor the track record of this pool versus the legacy pool, and can even show combinations of the two, right? If there's an interest and appetite from the board for that.
Right. So I think that's an important indicator for the board going forward, is that strategies can be set, but it'll allow an opportunity for a true review under the spotlight of this whatever we select this morning. So
Can I ask one more question?
yes, of course.
Lazaro Guzman, board member. Just going back to the length of the program, the dollar cost averaging program, did we say we were going to do it in 1/6? Is that right, Chris? So a sixth pretty much immediately, and then a sixth every 3 months?
And that's how, Lazaro, we had envisioned it. Yes, just as a simple, right, flat a run across the 6 quarters. One of the things that we hadn't, I think, talked about or settled on explicitly that maybe we should spend a minute or two on is any rules around, for example, accelerating or changing that timing based on market dynamic. So certainly we hope this isn't a scenario, right? But God forbid, maybe in the fall, what if, equity markets undergo a rapid 10, 12% repricing? Do we accelerate, right? That next wave and pull that into time now to take advantage of that? I think that's certainly something we probably want to all be collectively aware of. But I think all things equal, yes, to answer your question, we'd envision just simply taking, call it $54 million across six slices.
Yeah, so when I think of the length of the program, just to clarify, so I'm thinking if we do a 6 at time 0, it's like 5 quarters, right? At the end of the 5th quarter, am I thinking about that? At the end of the 5th quarter, we do our 6th investment.
Yeah,
Just
that's
because
fair.
Yeah, and not to be nitpicky, just because as we think about if we want a maturity match, it's more like 1 1/4 versus 1 1/2. That's the only reason I bring it up.
Yeah, that's a fair point, Lazaro. It's something we
Right.
kind of thought about and debated, and we left the framework this way. I guess it would put you in theory, right, somewheres between portfolio. You're right. We could reweigh these slightly if the board decided that, and it wouldn't be, and get that down to 1 1/4. We drive a little bit more into the short term stuff, and it would bring the yield down. Call it to probably what are you saying here? Maybe mid 60s yield, maybe low 60 yield, something like that.
Yeah, and at least for me, I wasn't asking, the numbers, at least for me, I don't want to speak for everybody else, they're not changing that much. So I'm not, I'd like to kind of come to a decision at this meeting. It was more just to kind of clarify the length of the program. It's not to ask you to rework anything. That's my perspective.
That makes sense. Fair enough.
Again, since I can't see everyone, are there any other questions before we look to make a recommendation here? No. I think to put something out on the table, I will make a motion, since I'm hearing no other further discussion, that the portfolio 3, the combined focus maturity match model, be what is implemented at the time of, actually it's 2 things. I think that we want to clarify that upon receipt of the funds, the first amount will be invested along the same lines as our current investment policy statement, and and then the, what do you want to call this? The cash, we want to, wait a minute. The bond proceeds, the remaining bond proceeds will be invested in the combined focus maturity match. So it's a little jumbled motion. I don't know if you want to try to read that back to us, Lori. Lori, are you there?
Sorry, I had muted myself. Okay, upon receipt of funds, the first amount invested will be pursuant to the investment policy statement, and the remaining bond proceeds invested in combined focused maturity match option. That's what I have
Okay.
for the motion.
All right. I've made that and seconded. I will now open that up to questions.
Nancy,
Sorry.
it's Pete Privitera, Finance Director. I'm just for clarification purposes. So, to Lazaro's question, are we going to be investing this over 5 quarters now instead of 6?
Well, the way I interpret it is the first tranche actually goes into mirror the portfolio that exists today. And then the next time you'll be doing the investment, and then the rest of those funds, I don't know, Chris, maybe you need to do the technical, sort of lay it out technically for us. Maybe I'm jumbling it in my head.
Yeah, I think the Chris Kachmar Fiducient. I think Peter, Lazaro's point is clarification is a valid one, right? when do you start that clock, right? You get the proceeds in and we've got a phase one. And then if we do it, I guess as envisioned, it is in fact over a 5, or it's a 6 event dollar cost average, but technically executed over 15 months with the, phase one, getting to work in the portfolio in immediate order. So,
Yeah,
I think
I'm just thinking out loud here that, at the end of the 6th period, we will be fully invested, correct? Or is it
Correct.
at the beginning of the 6th period? I'm only asking because all of our documentation and correspondence to various, agencies and whatever have identified we're doing this over a 6-quarter period. So if we feel comfortable saying yes, that we are doing this over a 6-quarter period, then I just want to verify that, in case someone comes back and says, well, why are you being more aggressive than you said you were going to? It's something to that effect. I'm just kind of speaking out loud here. That's all.
Yeah.
Yeah, Chris Kachmar, Fiducient. I'll defer to the board, obviously, on that, but I think we are clearly kind of setting up the structure and contemplating a 6-window dollar cost averaging framework. Right. I guess in a technical sense, we're fully invested within the 18-month, inside the 18-month window with the day one event.
Okay, as long as we're all,
Yeah.
we're all in agreement, I'm fine with that. Thank you.
Okay.
Ethan Goldman, member question. Is there any reason we can't do it over 7 entry points? Split the money up into 7 increments instead of 6? I'm fine. I prefer the extended time, frankly.
This is Nancy Dean speaking. I think, Peter, would that complicate from what you've already been putting out there as our process?
I think from my perspective, I'd like to keep it at 6 only because that's been what we've been communicating to the rating agencies, and that's already stated in our preliminary official statement. Granted, it's up to the board to make that final determination, but I'd like to keep it within the parameters that we've already established, because it would make it,
Well, that's why I thought the 7 would fit your issue of the 18 months.
Well, if we're saying that at the end of the 6th quarter, or during the 6th quarter, we're going to be fully invested, then I'm fine with that. I guess it could be a question of semantics, whether it's at the beginning of the quarter or at the end of the quarter. But as long as it's within that quarter, and we feel comfortable saying that we've gradually invested this money over a 6-quarter period, then I'm okay with that.
And I think that would be what we're looking at. I know it won't be certainly on July 1st, but if it were July 1st, then that would be your Q1, and the 6th quarter would be October of 22nd. But that would be the trigger date that we would be fully invested. Then you'd complete the program. So that would be 6, right? Chris, you might.
Right, correct. Chris Kachmar, Fiducient, correct. And that's the way we've kind of viewed it.
Right, and I think that it is that interesting nuance that Lazaro brought up, which is, are you starting on day 0? Is it? Do you consider that first investment in your 1st quarter or your 0 quarter? Is that what you were trying to say, Lazaro? Did I say or backwards?
Yeah, and in total length of time will be done in 15 months. But I still think, to everybody's point, that we could just say it's 6 quarters. It's just at the beginning of quarter.
Exactly.
So it's 6
and I mean,
tranches.
Right,
Yeah.
because the technical trigger happens in that 6th quarter.
In the beginning.
That would be what I envisioned. Yeah.
Yeah, but when we're going to be done in 15 months, And the reason I brought that up was just in terms of maturity match, but
Maturity match,
I'm all set.
exactly. Yeah, no, I hear you too. And I think
Yeah.
to try to dovetail it exactly to that period of time might not be in the best interest of the process. The maturity match, I mean, so.
Yep.
Okay, yep. Okay. So, maybe I need to make the motion. I will create a new motion that says these funds will begin to be invested upon receipt under the scenario described, or the investment allocation described under portfolio 3 combined focus maturity match. So,
Nancy, can I ask a question?
yes, sure.
So it's a yes or no vote the way you're proposing it. Is that correct? Because I personally prefer portfolio 1. I'm fine with 3, but I prefer portfolio 1. Is it possible to make it a portfolio 3 versus 1? Because I don't think there's any, or I'm assuming we're doing this over time.
So your recommendation would be to go with portfolio 1?
Yes, I'm fine with 3, but I prefer 1. So my question is, for the vote, as opposed to portfolio 3 or nothing, portfolio 3 versus portfolio 1. It's a request. I don't know I assume I could be outvoted anyways, but.
No, not necessarily. We haven't taken a vote, Ethan, and this is always the challenge of my not being able to see the whole room or being around the same table. And I would say then that there is a motion on the table to go with combined focus maturity match, and now there is a question to move that to portfolio 1 short-term focus. I will, I think technically, Lori, do I have to in order to entertain or change it to a short-term focus portfolio? I either need to rescind the recommendation, or take a vote, and then if it fails, we'd go to the next one. That'd be what I should do.
Hey,
Vote. Lazaro?
Can I offer a quick suggestion, only because I'm sort of between 1 and 3 also.
Mm-hmm.
Maybe can we just ask Chris, so we've narrowed, I don't know if everybody has, but it sounds like maybe again, I don't want to speak for everybody, maybe we've narrowed it down between 1 and 3. And I don't know if either others or maybe Chris just kind of want to make some comments as we think about kind of moving from 2 to 1.
I'll defer to the chair, but happy to comment. Chris Kachmar, Fiducient.
Yes, Chris, please.
Thank you. So I think we had, we've talked about it a couple times, right? I think we had started the exercise and analysis in supporting Becky and Bill and the rest of the team with that portfolio 1 is kind of the modeled, right, most conservative mix, particularly given the landscape, and portfolio 3 was in a way a deference to the board's desire to at least investigate some longer duration, potentially higher yielding configuration. So that's kind of where that came into focus. Between the two, right? If you look at just the duration versus yield comparative, it probably, frankly, all things equal, in the spirit of conservatism, probably takes you, to short-term focus portfolio 1, only in that, we've cut the duration fairly dramatically, and yet the yield has not been compromised to that same level, if that makes sense. So again, I guess I would just offer up the reminder to the board that originally the focus and the intent was an ultra-conservative, short-term, principal-protected framework, and that was the basis for some of the modeling, which is indeed portfolio 1. and portfolio 3, I think, is a thoughtful a compromise. Again, premised on the fact if the board wanted to reach for a little bit more yield, that would be the most thoughtful way to do it. Other things equal, so that probably only served to confuse the issue, but just a reminder from where we had kind of started the whole exercise and coming full circle. We were centered on the ultra conservative mix when we were doing some of our work back to support the bond offering itself.
That's helpful. Thank you.
Yeah, and this is Nancy. Yeah, thank you, Chris. I think that is exactly how these different scenarios began to be developed, was also keeping in mind that this is a time horizon that we'd be putting the funds to work. So we wanted to be mindful of that from the overall perspective. But with that in mind, I will withdraw my motion for portfolio 3 combined focus maturity match. And since I'm the one that makes the motions in this virtual environment, I will say that I would recommend that we go forward with portfolio 1 short-term focus for the new funds that are coming in. And with that, I will ask Lori to poll, please, for the vote.
Sure. Thanks, Nancy. This is Lori Kearney, clerk of the board. Peter Privitera.
Kind of torn here, but I'll say okay, yes.
Ethan Goldman.
4. Or yes.
Al Lebo.
So I'm fine with it. So I will say 4. I would have been fine with 3 as well. It sounds like there are 3 of us who are fine with 1 or 3. So Peter, you and Nancy really need to be the ones who are kind of the swing fighters there. But for the vote, I say.
Lazaro Hussein.
Yeah, I asked for that other scenario, but I don't know that we pick up that much more yield for the risk. So I'm for portfolio 1.
And Nancy.
I am actually voting for against.
Okay, that's 4 in favor and 1 opposed. Motion carries.
Okay, great. So Chris, you have your marching orders, I guess, right? Chris and Peter.
If I may, Madam Chair, just quickly, and then I'll stop on just so people see it on page 24. I think it was in the spirit of the discussion, but you do see Peter just with the worksheet, if that's available to show folks the simple deployment of the 54 million across the existing portfolio as envisioned. So I don't think there's anything particularly noteworthy here, but just a visual reminder for the board on where those monies will go in slug 1 in early July.
That's right. And I think this is Nancy. Thank you, Chris. I did study this, and remember, we do want to remind everyone about the perhaps waiting to get into the Barings Fund, or have you made any progress with that?
We've had conversations with Barings. As folks may remember, there can be entry queues there on occasion. They don't have one right now, but there are some notification provisions periodically. They're usually 30 days in advance of an intended expression to put more monies to work. We're obviously inside that window for their next opening, which is July 1. We have had preliminary discussions which suggest as an existing client, the town would be eligible and we could accelerate working with Peter, the paperwork and gain entry, the $4.5 million into the Barings strategy for the July 1 liquidity window. We just, you see there, we do note provisional on the small chance that something happens where they decide that we have to wait until October, which again, we don't think is the case, but if it were to be, we would just redeploy those monies proportionately and look to do that, catch up, if you will, with Barings in sleeve 2.
Right.
But I think we should be in good working order for July 1 based on our latest conversations with Bearings.
Good.
Question.
Yes, Lazaro.
Sorry, Chris, I thought you said 30-day advance notice. So if we didn't get in July 1, I would have thought we would have gotten in August 1. Did I misunderstand something?
Yeah, it's Lazaro, just Chris Kachmar, Fiducient, I'm sorry. It's a quarterly entry.
Quarterly,
So
okay.
it's
Yeah.
July, October, January, and April.
Gotcha.
Yeah. And same thing on the exit, I think, too, right, Chris? Although we're not there now, but just so that everybody understands that.
Yep, there are notification provisions as well.
Right.
Nancy, I have a question.
Yes.
This is Al Lebo, board member. So I just want to clarify, just make certain that I understand exactly what's going to happen here. We're issuing 325 million of bonds. A sixth of that will be put into our normal investment strategy that you're presenting here. The other 5/6 will be put into the scenario 1 we just talked about. Now, if for whatever reason we don't have, don't sell the full 325, what in the next couple of weeks, what happens then?
I'm sorry, if we don't get the full 325, did you say?
Yeah.
You mean if the subscription wasn't, if it went to market and it wasn't, is that what you mean?
Yeah. If we didn't fill the full 325 by whenever we start investing into this manner, how does that work?
Well, I think, well, I really need to defer to Pete, but I think that the indications are, and nothing's certain, obviously, as your question points to, but I think the indications are that you'll be fully subscribed. Pete, is that the feedback you've been getting?
Yeah, I'm hoping we'll be oversubscribed, actually.
Right. I mean, I thought
that
we
we'll
would
have
be
more orders
oversubscribed,
than,
but fully. Yeah.
But what's going to happen is we have a call Tuesday evening with the underwriting syndicate, and they're going to give us some indication of what the market outlook is. I mean, if there's any indication that we're in a position where we do not have investors that are going to buy our bonds, then obviously we would hold to see what the situation was. But my expectation is that we're going to have a lot of orders in. The underwriters are going to have a lot of orders in for these bonds, simply because they're AAA rated bonds, and I can't imagine that we would be undersubscribed at all. So, but
right.
If something were to happen, then we would.
Right, right. And I'm interrupting. I'm sorry, but if there were, if something did not go well on that call, or the feedback that you were getting was different from what our expectation is, then I think Pete would certainly inform the pension board right away, so that it wouldn't be something that the pension board members wouldn't have an opportunity to be aware of till.
Yeah, I think my first call would probably be to the mayor and town manager and
right. Yes.
Know.
Yes.
But again, we have never been in a situation. Well, I shouldn't say never. Since I've been here, we've never been in a situation where we haven't been oversubscribed. We've never been undersubscribed. So, it's a good question, but I can't imagine we're going to be put in that position.
Right. Alan, do you have a particular concern in this regard?
Oh, absolutely not. I just wanted to understand, how this investment works, and if things don't go exactly as we're talking about here, what can, do you just invest what you have? Do you sell for higher interest rates? Do you, how does it work? And not because I had any concerns whatsoever that would be the situation. I just wanted to understand how this whole mechanic works.
Okay. Well, I would think that the pension board would be not on Pete's first call list, but if the subscription fell short, we would certainly learn within a relatively short period of time. So I hope that doesn't happen.
This is Mayor Cantor. I mean, we had interactive meetings with the rating agencies. The fact that is a very strong AAA, an affirmation of the AAA bond rating. So that says a lot, and that was a big hurdle to get over. And so we're feeling pretty bullish about how this will be received when it hits the street.
Thank you. Okay. We have one other order of business today. I have a couple of remarks to make. First off, you did notice that we had a visitor here with us this morning, Perry Salonia. And before I forget, Lori, I would ask that you send a copy of our current investment policy statement to Perry. Perry, we do affirm it every year, but just certainly want you to have that. Perry, I think many of you know that I have been here on the board. Maybe my hair was black when I started, but I'm over the 10-year limit. I've been here 10 and a half years, I guess now. And during this time, it has certainly been a very interesting process for me as I learned things and learned more about the town and worked closely with all of you. And with that, because of the requirement, I am a little overdue, or I'm overdone, I guess. Is that the way to say it, Mayor? I'm beyond done, so it's time for me to step down. Perry will be voted upon tomorrow evening at the town council for an appointment to the board to replace my slot. And I would now like to make a motion to nominate Lazaro Guzman as the pension board chair, effective at the end of to close this meeting. So I make that motion. And because it's a virtual meeting, I don't need a second, which is sort of interesting process, I guess. I do think it's unfortunate we couldn't all be together for this meeting. It would have been a very good time for us to bring particularly this very difficult investment thinking about what to do with these new funds. It's a high-class problem, as I like to say, to have new money to work with, but these are very challenging times. So I thank you all for your patience in that regard. So I will now ask Lori to do the roll call for that vote.
Okay, thank you, Nancy. Lori Carney, clerk of the board. Peter Privitera.
I'm going to say yes, but I also want to say it's been a pleasure working with Nancy. I've been on this board for 8 years, and Nancy and I have seen a lot, but she's always been the best person I can always rely on in terms of advice or comments. And I'm truly going to miss her, our little conversations that we have. And I just want to wish you the best. But Nancy, I'm going to miss you. I just got to tell you that. Thank you.
Well, thank you very much. Thank you.
Okay. Ethan Goldman.
Yes.
Al Lebo.
I vote yes, and I would also like to thank Nancy. I have not worked with her nearly as long as Peter, but I certainly have enjoyed working with you in the time that I have been working with you.
Thank you, Alan.
Well, this is interesting. I was going to call Lazaro. Does Lazaro? I guess he gets to vote, right?
Absolutely.
So
Yes, he
Lazaro,
does. Yes, he does.
I'll vote yes, but I also want to say, Nancy, I know I've got very big shoes to fill. I've enjoyed working with you. I've enjoyed learning from you, and we've got a great board. So I look forward to working with everybody. And I know, you leave us in really good shape. But it's been a real pleasure. Thank you.
My honor. Thank you.
last but not least, Nancy.
Oh yes, I vote yes. I do. And again, I don't mean to ramble on, and our time is a little over this morning. So, but I do thank all of you, and this has been sometimes very, very tedious and very challenging to work through with our advisors from Milliman and from Chris and Fiducient, and It's a really wonderful effort, and I'm very excited to hear how the bonds sell. So there you go. Thank you all.
And Chairman, Madam Chair, can I say a couple? Thank you so much. I just want to, first of all, anybody that steps up to volunteer to serve public service, I am so grateful for all of your time, effort. You really take this seriously, and I'm so appreciative. And this is a big deal and has a big impact on the town finances, but on our quality of life and what we can do as a community. So it's much bigger than so many other boards and commissions. This has actually been one of the biggest challenges of the town. And so Nancy has led us through some really significant change, and I think a point of stability for the town in this challenging, really throughout this really challenging period, this decade of a really accelerated defunding. Almost, it was almost like, where the numbers, just every time we tried to do something, it was step down
Got harder.
funding. Yeah, it's just been so challenging. But what I can say is that Nancy has done this with grace and grit, as is often we use that for women, but in a world that actually, there aren't a lot of women that represent. You just have led with such professionalism and respect. And I am so grateful for your commitment and leadership. And so much has happened behind the scenes to make the board run smoothly. And I appreciate that very, very much. And I want to also thank Perry for, volunteering and stepping up to serve, because it's a big deal. And I want to really thank all of you for your effort and your time. It's really important and matters a lot, and it makes our community very special. Thank you.
Thank you. Thank you very much. All right, Lazaro, you get to close the meeting now.
Well, thanks, everybody. I guess motion to adjourn.
Congratulations, Lazaro. Thank you.
Thank you, Lazaro. Bye.
Look forward to working with everybody. Thanks.
Okay.
Thank you so much.
Bye, Rick.
Bye.